Right now, most people carrying life insurance have no real idea whether their number is actually right. They picked a round figure that sounded big enough. Or they took whatever a salesperson suggested, and then they just hoped. Go too little, and the people you love are left short at the worst possible moment. Go too much, and you're paying every single month for coverage they will never use. Here's the good news. There's a simple, honest way to find your real number. It's called Dime, and by the end of this, you'll be able to run it yourself in about 5 minutes. This is Calm Dollar, where we take the intimidating parts of money and make them calm, clear, and usable. Life insurance is one of those topics almost everyone quietly avoids because it forces two uncomfortable questions at the same time. What happens to my family if I'm gone? And how much is actually enough? So people either skip it entirely, or they overpay for something they were talked into, or they grab a random round number and move on. Today we fix that with one simple framework. If plain English money with zero hype is your kind of thing, consider subscribing. Stick with me, because by the end you'll have a real number instead of a nervous guess. Let's start with why the guessing is so costly, and it cuts in both directions. Go too low, and you defeat the entire purpose of the policy. The whole reason life insurance exists is to replace what your income quietly does for the people who depend on it. The mortgage payment, the groceries, the child care, the future you are building for your kids. If the payout runs dry in 3 years, but your children are 5 and 7, you haven't protected them. You've only delayed the problem. Now swing the other way. Plenty of people get sold far more coverage than they need, or the wrong kind entirely, and end up paying month after month for a policy that slowly drains money they could be using today. Both mistakes grow from the same root. Nobody ever showed them how to size it, so they anchor to a number that simply feels right. When life insurance was never a feeling, it's a calculation. And it matters more than most people assume. Survey after survey finds that, among families who carry any coverage at all, a large share are still underinsured, holding a policy that would quietly run out years before their family actually needs it to. Here's the calm way to think about it. Life insurance, at its core, is income replacement. It exists to stand in for the money you would have brought home, so the people who count on you can keep their footing. So the real question isn't how big should my policy be, it's how much money would my family actually need to stay okay if my income vanished tomorrow. And there is a clean little framework for answering exactly that. It's called DIME, spelled D-I-M-E, and each letter is one thing your policy should cover. Debt, income, mortgage, education. Add those 4 together, and you get an honest estimate of your number. Let's walk through them one at a time. D is for debt. Add up everything you owe that isn't your mortgage. We'll handle the house separately. Car loans, credit cards, student loans, any personal loans. You want the policy to wipe these out so they never land on your family's shoulders. Then add a little for final expenses, because a funeral alone can quietly run into the thousands. I is for income. And this is usually the biggest piece by far. Take your annual income and multiply it by the number of years your family would need that income to keep going. A common starting point is 10 times your income, but fit it to your own life. If your kids are little, you might want 15 or 20 years of replacement. If they're nearly grown and your partner earns well, maybe fewer. This is the money that quietly pays the everyday bills, the part people always forget to count. And here's one people leave out entirely. Don't zero out a stay-at-home parent. The childcare, the cooking, the driving, everything they do would cost real money to replace if they were gone. So their contribution deserves a number in this too. M is for mortgage. Add the full remaining balance on your home loan, so your family can either keep making the payments comfortably or clear the house entirely and stay put without that monthly weight hanging over them. E is for education. If you have children, estimate what you'd want to help cover for their schooling down the road. Put a realistic figure on each child, and multiply by how many kids you have. And that's the whole method. Debt, income, mortgage, education, added together into one honest number. If this is clicking, subscribe so the next one finds you, because now comes the part that makes it real. Actual numbers. Let's run Dime for one made-up family, using round illustrative numbers. Meet Sam. Sam earns $60,000 a year, and has a partner and 2 young kids. Start with D, debt, a car loan, and some credit cards come to about $15,000, plus a few thousand for final expenses. So call it $20,000 total. Now I income $60,000 a year, and because the kids are young, Sam wants a full 10 years of replacement. 60,000 times 10 is $600,000. That's the heavy one. Next M, mortgage. The remaining balance on the home is $200,000. And E, education. Sam wants to set aside roughly $50,000 per child to help with school. And with 2 kids, that's $100,000. Now add it up. $20,000 for debt, $600,000 for income, $200,000 for the mortgage, $100,000 for education. The total comes to $920,000. So Sam's honest number lands somewhere around $900,000 to $1 million of coverage. Not a figure pulled out of thin air, but one tied directly to the life it's meant to protect. Now, before you rush off to shop for $1 million policy, there's one more move that can save you real money. Step 1. Run your own dime, with your real debts, your income, your mortgage, and your kids. Step 2, and almost everyone skips this, subtract what's already covered. If you have savings, or a policy through your job, or a partner who also earns, you may not need the full amount out of pocket. Say Sam already has $50,000 in savings and a small policy at work that shrinks the gap you actually have to buy. Step 3. Match the length of the coverage to the length of the need. If the whole point is getting your kids to adulthood and the mortgage paid off, coverage that lasts exactly those years lines up neatly with the job. That's why, for a pure income replacement need like this, many people find that straightforward term coverage fits well. Level protection for a set number of years at a small fraction of the cost of permanent policies. Step 4. Get more than one quote. Prices for the very same coverage can vary far more than you'd expect, so it genuinely pays to compare a few before you commit to anything. And one last thing, your number isn't frozen in stone. A new baby, a bigger house, a jump in income, or a debt you finally pay off all change the math, so it's worth rerunning dime every few years, or right after any big life change, to make sure your coverage still fits. So let's bring it home. Life insurance isn't a feeling, and it isn't a round number someone talked you into. It's income replacement, and you can size it in minutes. Run dime. Add your debt, your income, times the years your family needs it, your mortgage, and your education goals. Then subtract what's already covered, match the term to the years of the need, and compare a few quotes before you buy. Do that, and you'll know your family is protected by exactly the right amount, not too little, and not a single dollar wasted. If this turned a stressful topic into something calm and doable, that is exactly what Calm Dollar is here for. So tap subscribe before you go. Next time we tackle a decision almost every homeowner wrestles with, the 15-year versus the 30-year mortgage, and the real trade-off that nobody quite spells out. And the reminder that always matters most. This is general education, not financial advice. Every number here was round and made up to show how the method works. Your own situation, your health, and the coverage you qualify for will all be different. So run your own numbers, and if it helps, talk with a professional you trust. Keep it calm and keep it yours.